this is the last technique under the capital budgeting decisions, internal rate of return, otherwise it's called as IRR. We have completed with the payback period, accounting rate of return, NPV, that is the net present value, profitability index, and we are in the fifth one, internal rate of return. What is the meaning? IRR is the rate at which the sum of discounted cash inflows equals to the discounted cash outflows. Again, now whenever we use the word discounted, that means we are using a discounted factor or a discount factor, right? As in we found out an NPV and profitability index. We have a discounted factor mentioned there, a percentage 10, 12 mentioned there, and based on that discount factor we are going to discount the cash inflows that will be equal to your cash outflows. So internal rate of return is a method that is adopted by companies or corporates by the accounts department in order to find out what is the exact return on a particular investment or a project if we invest a sum of amount of money in it, right? That's why it's called as internal rate of return. The accounts department or the company's internal advisor is going to work on this method to find out where exactly does the return or the percentage of return will be earned. And now here in this IRR we're going to have a range, right? Now let's say 10 to 15%. Now because it's internal, we are just estimating it, we are just anticipating the exact return. Therefore, we are not going to stick to 1%, but we will calculate 2%. That means two discount values. One is the lower one is the higher one. For an example, 10% and 15%. So 10 is the lower discount value, 15 is going to be your higher discount value. So based on my calculation, which is called as IRR, my return on investment will fall somewhere in between 10 to 15. Okay, so that is the calculation, how it goes about. So we have the formula here, internal rate of return equals to LDR, as I told, lower discount rate, plus the total present value of LDR minus original investment divided by total present value of LDR minus total present value of HDR multiplied by HDR minus LDR. That means what? Higher discount rate 15% minus 10%. So 15 minus 10. Those will be the values. But with these values, when you're combining with the cash flows, when you total it up, it becomes total present value of LDR. So here you're going to write the amount of LDR and HDR. Here only the rate. Higher discount rate minus your lower discount rate. Then how do I find out the IRR factor? Original investment divided by the average cash flows. How do I find out the average cash flows? That is the cash flows after tax before depreciation divided by the life of the project or asset. Now remember, we have 5 different techniques of capital budgeting, out of which only the second one, that is the accounting rate of return, uses earnings after tax, right? Basically it is not going to add back the depreciation. As it is in the books of accounts, it's going to assess my return on project, whereas all the other 4 methods including IRR is going to assess based on cash flows after tax before depreciation. That means after deducting on the basic earnings, I deduct depreciation, I deduct tax, and then I add back depreciation, because I need to know the exact cash in hand, because we know already, we have discussed what is why is depreciation called as a non-cash expenditure. That's the whole reason why for all the other 4 methods we are trying to add back the depreciation and then calculate the return on the project or asset, right? So average cash flows is the cash flows divided by the life or the term of the project or the asset. Hope you have understood the concept of internal rate of return and the formulas. We'll start solving the practical problems now. So we are starting with the first question of internal rate of return. The given details are original investment is rupees 6 lakh. As I told, IRR is always between between a range, right? The lowest and the highest. So the mentioned lowest discount rate is 12% and highest discount rate is 15%. So what you used to do for net present value and profitability index, that is multiplying the first find the discount factor values, multiply them with the cash flows and then find out the total present value. Here you will do it for both 12% as well as 15%. Got it? So start with the year. Cash flow is given in the question. In case, remember here directly they are given as cash flows. In case they have given us earnings before depreciation and tax, then you need to do the entire income statement, find out after taxes and before depreciation and then solve this table. Since nothing is mentioned, we assume the cash flows are after tax and before depreciation. Then LDR, that is 12% mentioned here. Find out the values at 12%. I told you right in the video, 1 divided by 1.12 for 12%. Then PV value at lower discount rate, cash flows divided by LDR rates. Okay, will come up to 6,34,150. And next is higher discount rate at 15%, 1 divided by 1.15. When you do it for 4 years, you get these values. Multiply the discount factor with the cash flows in the second column. You will arrive at the PV values. The total is 5,93,500. So once you have completed this entire table, finding out both lowest as well as the highest, then we can implement in the IRR formula. So after the table, use the formula IRR equals to LDR plus total present value of LDR minus original investment divided by total present value of LDR minus HDR multiplied by HDR minus LDR. So as implemented, what is the lower discount rate mentioned in the question? 12. So 12%, the total of LDR minus original investment is rupees 6 lakh mentioned in the question, divided by 6,34,150 minus higher discount rate total present value 5,93,500 multiplied by higher discount rate is 15% and minus lower discount rate is 12%. So 12 plus 34,150 divided by 40,650 is just the solving of this step, and then multiplied by 15 minus 12 is 3. So 3 I put in the bracket, and then 12 plus, once we divide this value we arrive at 0.84. I am going to multiply it with 3. I get 2.52. Once I total it up, add it up, I come up to 14.52%. So IRR is somewhere between, as we calculated, it must be between 12 to 15%. So my answer is 14.52. So your answer, make sure it always lies between these two rates. The final answer must always range between these two, 12 to 15. In between that must your internal rate of return come up to, the answer come up to. Okay, so with this formula we complete your first question under IRR.